Today's guest is someone who doesn't just talk about investing. He talks about thinking, about long-term conviction, about discipline. We're joined by Bahram Assadollahzadeh, who is an investor, entrepreneur, and the founder of RICHTWERT Capital. But more importantly, he's a deep thinker when it comes to ownership, growth, and long-term business success. Bahram challenges the short-term mindset that dominates the market today. He speaks a lot about investing like a true business owner, focusing on fundamentals, long-term value creation, and emotional discipline rather than noise, hype, or speculation. He often draws parallels between investing and entrepreneurship.
And I think it should probably just be worthy to mention as well, just the context of the conversation that we had this in. So we filmed this on the Sunday, which was one day after the attacks on the UAE by Iran in the whole conflict that was going on. So just huge credit to Bahram as well for, still coming on our podcast and still giving us a great and valuable conversation given the current environment. But without further ado, let's just get right into it.
Well, Bahram, thank you for joining us. I know it's a bit of a tense time in the UAE especially, but the show must go on, so we're here, we're recording. You're obviously very skilled, very knowledgeable in the finance area, but we want to get to know a bit about your growing up, how you started, how you even got into this area.
Okay. Yeah. Well, how far back do you want
As
to
far
go?
back
As
as
far
you
back
want.
as you feel necessary, yeah.
Well, I think I always my passion was always related to businesses and how businesses do, and I think it started in my childhood because my dad he used to be an importer of car parts, and he had his business where he sold. And after school, many times when he picked me up after school, I went to him, was in his office or where he had his shop, and did things. So I saw customers come in and negotiations going on, inventory coming in, going out, and things like that. So that entrepreneurial spirit and experience just made me always be interested in business and understanding how businesses work. And I think it started with business, not necessarily with investing. Yeah, that's how I got started.
How clear do you think it was in your mind watching your father, take that entrepreneurial step, that for you post schooling, that would be a thing that you felt you were going to naturally go into?
I mean, I was interested in doing that, but I was also, like many people, just interested in a lot of things. I was thinking about becoming an industrial designer for like cars or objects that are being designed. That was one area. Medicine was an area that I was interested in going in, and it was mostly then after school when I wanted to start college. It was mostly trying things and finding out, oh, this is not really what I want. So there was a lot of trial and error, and I just remember, being brought up that way. My dad said, whatever, because I was very interested in physics. So I wanted to actually study theoretical physics and astrophysics. And he said, you can do that, and it's scientific and it's good. But he said, if I can give you one advice is try to do something in your work where later on you can be on your own. And I'm not sure if physics is one where you can. So I think that was a little bit the area where then I started then from the sciences, although I was interested in them, to go more towards business.
How did you know what was right and what was, you didn't want to keep going with? What was the path to go forward with?
Yeah, the trial and errors were really trials. I studied a combination of MBA and industrial engineering, mechanical electronic engineering, and so forth. Because one of my teachers said, everybody does MBA, try to have at least some engineering background in it, so that later on when you're applying for jobs, you can stand out a little bit more. And then you had, like in college, we had to take internships. There were mandatory internships. So I was like, okay, I'm going to go with electrical engineering first, try that. And then I did an internship at a car manufacturer like Mercedes-Benz and stuff like that. And all of the things that I went into were interesting, but my heart wasn't into it. And some of it was like, oh, this is very different than I imagined. I'm glad I experienced it for a few weeks. I'm gonna go find something else. Yeah.
And how much do you think, jumping around a bit and putting your hand up to everything, including, moving around to multiple cities within the US and just, as you've already spoken to, just that kind of trial and error process, like, do you feel you were just searching to take, whether it be one or two key things out of all those experiences that you could culminate and bring together to forge your own path?
I think it was definitely beneficial to see different cultures, different backgrounds, different economies, from Iran, Germany, USA, and just traveling and seeing things, because it gives you different mindsets. Like, for example, in Germany, everybody is very modest, even though they might be very, very good at what they do, right? They always downplay it, and but in the US, it's a little bit the other way around. Like, everybody wants to become a CEO within the next 3 years, and but also the belief that it's possible and that you can do it. I think growing up in these different environments helped me have like a balanced view, where I saw like people are maybe too conservative or too shy or not going for it, not trying to strike, hit the ball out of the park. I was like, okay, now this is a momentum that I can jump on. And otherwise, also in other areas where I thought, okay, maybe people are taking too much risk or not aware of what they're actually doing and what it means. They're like, for example, having a background from other cultures was helpful. So I think the mix, uh, I always felt, I have a good backpack of things that I can fall back on to see, how I go about things.
And how did your early business years experience, how did that kind of shape your view on risk, and not only in the business space, but broader, in a broader perspective, life as well?
Well, I think one of the most dominating things was I was preparing for my thesis. I was doing exchange studies and starting to work on my master thesis. And back then I was in Silicon Valley. So a lot of companies, I was working at a consulting company. A lot of startups would come and pitch their ideas to us to get funding or to get IT resources to be able to do their things. So I would hear a lot of business ideas. And one of the ideas that I heard was about a search engine for shopping, comparison shopping. And at that time, it was a novel idea. So when I came back to finish my master's thesis, I said, this they started it in the US, but nothing like that exists in Europe. So that's what the first business that I went about. So it was an e-commerce search engine business that we did with a small team, and we ended up selling it to a company that was the equivalent of Yahoo in Germany, and there I was responsible for business development and e-commerce at that company. So it was in a very short period of time, a lot exposure to a lot of things. It was back then. It was the right when the internet bubble burst, so it was still a little bit of the internet bubble there, and then it bursted. So it was talking to venture capital companies, setting the strategy of the company, suddenly feeling like you're the CEO of a small company and doing things like that. But yeah, it was very formative. And the other thing was the company that acquired us gave us some cash, but a lot of stock options in their company, and that was, let me say, maybe April of 2000. And all those stock options, I mean, there were a lot of options, so it could have been worth a lot. But back then, everything was overvalued very much. So those stock options turned out to be worth zero, right? And that was like a moment when, for the first time, I realized, okay, in markets, like in stock markets or in public markets, that you can have times of enormous distortion from reality. Because I mean, even now the stock options wouldn't be worth anything, and it's like so many years out of the water. So I was like, okay, these markets, like what you hear in the stock prices and stuff like that, sometimes it's just very far from reality. And that was, I lost a lot of money that way, because I thought, with the exit we had money, but most of it went away. And some of the money that I had invested, I lost as well. So a big part of the fortune was gone, and I went back to consulting, and then I told myself, okay, now, you take the time, learn about business, learn about investing, And then once you know what you're doing, come back and try to do something again.
Well, yeah, I think you briefly skimmed over that period in your 20s when as you spoke to, you co-founded Bazaga, which seemed like a primitive Amazon at the time. So yeah, what was the tipping point, I guess, for you to co-found that business? And then as you spoke to at the end there, how did the tech boom around the 2 years of the 2000 really change where you felt your future could go and where you could end up on a future business venture?
Well, it was, first of all, just, getting a group of people together behind the mission, driving that, and, having all the different stakeholders, finding companies that you want to partner with, companies where you want to maybe get financing from, trying to get by with the finances that you have. And so that was formative in its own. But it was also interesting to see that, with very little input, you had the potential to create massive outcome, which normally, especially in Europe, you don't get to learn. Like, okay, you go to work for an employee, and if you're good, you rise up in the ranks over the years, right? But then suddenly back then, there was a window of opportunity. It was like, oh, it's possible. You can create a lot of value if you're in the right place, have the right mindset, get the right people together. Even though it didn't turn out to be that big thing, it gave me a lot of valuable things, and also the confidence that, yeah, it's possible. You can do things like that.
What advice would you give to people starting something like that today?
Yeah. Well, I think one advice, what I learned from that business and also from businesses that I started later is, I think when you have a passion for something, you can focus is enormously important. Like by being focused, because everybody is distracted, and the older you are or the more entrenched the business is, the easier it is to be distracted, right? So if you really like something, and you can be great at it, and you can focus it, you can get people around it, you have an enormous advantage versus incumbents. I don't care who they are, right? You can do a lot of things. That's one thing, just to have that belief that focus can change a lot of things, has that power. And the other thing is to give you a long runway. Like if you play with the mindset of this is a forever game, right? This is not a game for the next year or the next 6 months or the next 3 years. I'm going to give myself the runway, the leeway to be able to play out this game, right? Then I think those businesses, if it's also a right idea that has product market fit, it's very difficult to fail, right? I think most businesses fail either because there's no product market fit, or people don't get along together, or they're distracted. Or what I see a lot of times is that they run out of ammunition, and that is time and finances, right? So if you can keep the cost structure low, be lean about the business, and because it's like climbing a mountain, right? You have an idea how you want to go, but then once you start climbing, right, you have to improvise. The world changes, so you have to, okay, now I've got to go do this. And you want to keep those optionalities open. When you keep them open, then you can navigate, and it becomes powerful.
No, it's cool insight. But when do you think you're more fascinated by evaluating businesses rather than operating inside one? We've seen you founded your main business now, RICHTWERT Capital, in 2015. So what moments and stages of realization came to that point where you were going to start that business?
Yeah. Well, I was, many things came together. I was investing on my own, and I was working at an asset management company where we were advising and managing money for pension funds, insurance companies, and wealthy individuals, endowments, these kind of businesses. And what I appreciated a lot about the investment management business is that you can maneuver a lot. So you have a lot of flexibility, right? So when you're running one business, that business can be a great idea, or maybe it's not that great of an idea. It's very hard to shift from that one business to another, right? If it's small, you don't have a big team and so forth, and you're young, you can do that more easily, but still, you're in the business until you decide, this is not the business, because you have to also try things and see what works, what sticks, and build and develop things. By the time you do that and you realize, maybe this is not the right business, you want to switch to another business, there's a lot of switching costs and time that goes by. When you're in investment management, it's like you have all the planes or all the trains or all the ships, however you want to look at it, of business ideas and sectors and different geographies, and you're free to move from one to another because the management and the teams are provided by others, right? So your capital is much more free to go from one business to another if you find out, this business I thought I understand, or I thought I knew the economics, but it turns out no, the economics is actually a tough business to be in. The competition is very hard, regulations, whatever it is, or the world has changed, right? You're much more free to say, I'm going to take my chips from here and go somewhere else, right? And when you're running your own business, that's just not possible, right? If you find out, pharma is the area to be in, but you're in real estate, right? I mean, make that shift, right? So it's that flexibility of being able to move around and also see these businesses from the top and be able to pick best overall instead of best in class only, like within one sector or within one geography. You have the freedom to, kind of be above it and, allocate. So that's what attracted me to that business. And but then I was just working as an employee and advising. The reason I decided to start my own business is because I saw that in this industry that the incentives are in a way that I didn't like, because people I learned about investing because I was a business owner myself, right? I was like, okay, you're going to be successful if the business is successful, right? But in this industry, unfortunately, because a lot of the investing is done with other people's money, right? There's a lot of, we'll try this, we'll try that. If it doesn't work, then, because it's not your own money, right? And there are management fees for running money, and the incentive is to keep the money so you can keep earning that management fee. Most of the industry is actually not trying to create the best outcome for the clients, but to create the best outcome for themselves, to keep that money invested with them so that they can earn the management fees. And then the decisions that are made are suboptimal for clients. And I thought, there's got to be an alternative to these conflicts of interests. There's got to be a better way to deal with people who trust with you with their savings and their money. And that's when I had my business. I said, if I go about it and I start the business, I want to make sure that it's not other people's money that I manage, but that my money is invested with them, that we're sitting in the same boat, right? That way we're completely aligned. It's not just that the company belongs to me, but actually they know that my money is invested in the same businesses that I invest for them on. That was one. And the other one was, I thought, it's hard to create value in this business because you can also just invest in indexes, right? You can just buy ETFs and so forth, be a passive investor and just take the market return, the average return. So I thought, my ambition was I wanted to earn something when I deserve something. So when I do more than what the regular people could do. So I said, okay, I'm going to make it only success oriented. So there's not going to be any fees that we charge. It's more like a partnership. I'm investing my own money. Other people who believe in my investment approach can also come with their money, and it's a partnership. If I perform better than X%, so I had set the annual hurdle rate of 6%. I said, if I set that, and if I exceed that, then my company gets a profit share. If not, if I just deliver a return that they could have done themselves, then I shouldn't deserve anything. I don't deserve anything, and I shouldn't get anything. So those were just the two principles: being in the same boat, only earning when you deserve it. And the third one was really having this ownership mindset that I had from having my own businesses, right? So for example, when I invest in the business, it doesn't matter if I'm only buying one share of a business or not. I always ask myself the question, would I be happy owning this business or part of that business, even if the stock market's closed for 5 years or not, and I could not sell, right? Would I be happy with the asset itself, right? Whereas a lot of people are like, we're going in, if it doesn't go well, then we sell, right? That's not an ownership mindset, that's a trading mindset, right? And those are the three principles that I said for RICHTWERT. And I said, if I do it that way, I think it's a fair partnership for people who trust my company with their money. But it also sets me up for making the right long-term decisions and thinking about which businesses we want to be invested in, so that we're not traders and we're not gambling with other people's money.
How important is making those strategic decisions? Thinking about the flow-on effects, more so just the direct impact that a decision like the decisions that you make might have.
Yeah. When you decide to invest in a business, being it can be a publicly listed business or a private business, right? You have to just look out for many years, right? Unless you just want to gamble, right? But that's a different game. But I think the difference between investing and speculating is that in investing, you have to have a certain degree of certainty that you're going to get your money back first and foremost. So protection comes first. And then you want to have an adequate return so that you have a return, that your purchasing power is protected from inflation and so forth. And if you don't want to make that just be by chance, then it's very important to be strategic, to be able to look out 5 to 10 years. Because in the stock market, for example, everything is the ups and downs and swings. They're very emotional, right? So I always say, you can be Warren Buffett in the stock market, and for 2 or 3 years, you can look like an ape that has his eyes blinded, in a bind, and you can't tell the difference in the short term, right? And the other way around. I mean, you could be somebody who understands nothing and just perform extremely well in the short term, right? But that's just, it's like rolling the dice. If you want something that is reliable, where you're like, okay, I am going to make money over time. You're not going to make it with every investment that you make, but over time and on average, I'm going to create an adequate return where the risks are under control. You have to have a framework of making those decisions where if you apply that framework, the probability of the downside risk becomes low and the upside is open, right? So if you play it that way, then you have a reliable framework for accumulating wealth over time. That doesn't mean you're going to perform extremely well in the short term or be better than stock market average, but over time, you're going to be more right than wrong, and that accumulates over time. And most importantly, you have risk under control. So that framework of how you go about that is very, very important.
And how transparent were you, from the establishment of your business to giving them an insight into your strategy and those 3 core principles that you spoke to at the start? And from that, was that just a very intentional play at trying to find a niche within I'm not sure what it was like back in 2015, but what seemed like quite a congested vertical in Switzerland and, Europe?
Well, you mentioned the concept of a niche. I think it's very important in whatever you do, being it investing or other kinds of businesses, to find an area where you have an advantage, right? Because the world is a very competitive place, right? So you can go brute force. You're going to say, okay, I'm going to outwork everyone. I'm more intelligent than everyone, or I'm going to put more energy in it, or I'm going to, throw more money at it, right? But that's not a strategy. That's like being in a rat race and just trying to, run faster than others, right? Yeah, you can do that for some time, but what stops other people from running faster than you, right? So what gives you strategy is actually thinking about how you're going to position yourself that you're not just running faster than others, right? It's helpful if you run faster than others and work harder or longer than others. You also need that. But to make it sustainable, you have to have an edge. You have to have something where even if they know what you're doing, they're not going to copy it. Either because it's too cumbersome to copy, or because they have a trade-off that they're not going to do. So once you have that, then you have something sustainable that you can build on, right? And for RICHTWERT, it was that. I was like, okay, it's so much easier to just bet with other people's money and not have your skin in the game with your own money, right? So why would they do that? And to this day, I mean, more than 10 years later, almost nobody does. Like the number of money managers who have a substantial amount of their own wealth in their own product is very, very low. Is way lower than 10%, right? They might have small tokens in there, but I mean, the most of their wealth is not where their funds are. So that was one. The other thing is, yeah, they had brands. They were well-known wealth managers whatsoever, right? And they could charge a management fee, right? And why would they give that away? Because they're making money whether they perform up or down, right? And making it success-oriented was something that I knew nobody was going to copy, right? So these are advantages that when people are building a business, they need to think about, can I create something that actually has trade-offs? Because a strategy means there's a cost to choosing a direction. If there's no cost, then others are just going to copy it, right? So you have to think hard about, okay, if I do this business and whatever it is, right? How can I make something that others are going to be like, I can't or I don't want to copy that? And then you have something, and then you have a niche that you can go after because, okay, this has a USP that you're not getting elsewhere.
Okay.
I want to talk a bit about adaptability. How do you, handle uncertainty, especially when, markets are volatile, even now? Like
Absolutely.
the markets, there's a lot of speculation about what's going to happen, oil prices, commodities, things like that. How do you and your business handle that kind of uncertain times?
It's actually a very good follow-up on what we just discussed because, again, instead of competing with everybody, I would like to go always to where the competition is low or non-existent, right? So when you look at commentary about stock markets and investing and so forth, everybody's focused on the macro, right? What's going to happen in geopolitics? What's going to happen to interest rates? What's going to happen to currencies? When are we going to have inflation? When is the next recession coming? These are all top-down things, right, from the macro. And they are important, don't get me wrong, right? But as important as they may be, they're also not really knowable, right? Everybody's just guessing about them. And the reason why they're guessing about it, they can't know, is because there are too many variables involved, right? Just to find out, where the economy is going to go, how much it's going to grow, when the next recession is going to hit, right? Where is it going to hit? Which industries? Which geographies? There's just so many variables. And even if you could, which almost nobody can, that still doesn't tell you anything about what the investments are going to do because there's not a one-to-one correlation. A lot of times when people are like, oh, yeah, the crisis is coming, right? It is more than priced in already in securities, so in stocks, for example, or in bonds, right? And with that, it's not correlated to each other. So I'm like, when I saw that everybody is focused on that, I said, okay, that's a game where I don't think I have an edge. I don't think they have an edge, but just competing with them is not going to make any sense. Where are they not focused on? And what they're not focused on is really looking at the business, right? Being it, a real estate business or a furniture business or a bank or whatever it is, and say, what are the economics of this business? And does this business have something that makes it special? Allows it also to go through ups and downs and ideally benefit also from challenging times, right? So going in the micro instead of the macro is somewhere where I saw, all the attention is going to the macro. Nobody's focused on the macro. That was one. The other thing is the incentives in this industry are so that you have to perform in the next quarter, in the next 6 months, in the next year, right? Almost nobody is looking out 3, 5, 10, 15 years, right? So there again, you can do exactly the opposite, right? You can invert things. Like, where's everybody looking at? Where's nobody looking at, right? So I tell always my investors that, okay, first of all, if you want to invest with RICHTWERT capital, please only come with money that can be invested for 5 years or longer. Not because if you need to go out, you can't go out. It's liquid. Everything is liquid. We're in publicly listed businesses. But I make my decisions with the time frame of 5 to 10 years, right? So I say, okay, you have 10 million, you have 1 million, you have 100,000. Think about how much of that you do not need over the next 5 to 10 years, and only come with that to my approach. Everything else you can do other things with, right? And then I tell them, don't look at the performance by year to year. Take 5-year running averages and see if we're adding value or not. And by training them or educating them about how RICHTWERT works, right? I think we have clients that are willing to look out multiple years. And again, that is something where the competition isn't, and it gives us an edge, right? So a lot of times they may be right. Well, we should sell now. In the next 3-6 months, this is going to go down 40%. They may be right. But it's a lot of times it's coin toss. They may also be wrong. But if you're not worried about the next 3 to 6 months, right? Wars happen, COVID happens, things like that. So all that noise you can completely ignore. You can say, is this business going to survive something like that or not? And if something like that happens, if a war happens, or if inflation happens, or some markets break apart, is this a business that would benefit? So is it anti-fragile, or is it fragile, right? And then once you're in the right businesses that actually during challenging times can actually move further ahead, increase the advantages versus the competition even more than so, then you don't need to time the markets, because actually a crisis is good for the business that I'm in, right? So you can just stay on that ship, and we can talk about the criteria, how to find those things, but that just gives you a different lens and perspective to go through the world, where you're just protected, and actually not only protected, but you actually do also benefit.
How do you feel compliance and regulation has really evolved within not only the environment in Switzerland, but on a global scale? And how has that really altered how you operate within your business now and going into the future?
Compliance every year and regulation has increased every year. So it just makes it more difficult. And it's also often driven by incumbents, because they can afford to have all the compliance and all the stuff, and the cost that comes with it. Unfortunately, for small businesses, it makes it hard. So, but I mean, there's only one way through it. As entrepreneurs, we either go through the wall, or we climb around it, or go above it, but somehow we have to get to the other side. So you just have to think about, accept and push back as much as you can, but there's not much that you can push back with compliance. But still try to find things like that are going to make you be able to manage compliance, and ever increasing compliance. Unfortunately, it has never gone down. It's just kept going up. One of the ways that, for example, in my business, you have to do things. So there's a lot of documentation that you have to do, a lot of information that you have to give to clients. Otherwise, they can come and sue and say, I wasn't aware of the risks that are being taken and stuff like that. So one of the ways that I thought about it, I said, okay, I started alone, and then even with a small team, I said, there's no way I can tailor strategies to each and every client or client segments, right? Because then you need to have multiple strategies, and then you don't have the focus that I mentioned in the very beginning of our interview. So instead of doing it customized for the customer needs, I turned it around and I said, no, what is RICHTWERT going to be great at doing? And then we communicate that, and then clients choose whether that fits for them or not. And if it does, for which part of their savings and money does it make sense, right? So I always tell my clients, this is what I do. Maybe it's not for you. Maybe it is for 5% of your assets, right? I have clients that have 100% of their assets with RICHTWERT, right? But everybody can choose and say, okay, I understand this is an opportunistic long-term approach, and not all of my money can be invested for 5 years or longer. Okay, 30% of my money goes there. But by doing it that way and not having to customize for each and every one, but being very clear for what we stand for, right? You attract the type of people, the partners that actually match you, and you can keep the regulation costs down because you say, I have one strategy, there's one criteria. I communicate it very clearly, they choose on themselves, right? So that helps to reduce the compliance things and that you need to do. So I think it makes just sense for every business to think about what game am I actually playing, right? If you take the restaurant analogy, it makes a lot of sense if you're doing sushi that you stick to sushi and you communicate that you're sushi, right? Because somebody who wants to have a hamburger or pizza is not going to select you, and that's fine. But then you can do whatever is needed for sushi really well, right? Whereas you're like, okay, I'm going to go by customer preference. That's a different approach. And that business model can also make sense, but you have to be very intentional, right? Am I going somewhere where I'm customizing and individualizing things for people, right? That's a very high touch business, right? It requires a lot of personnel, for example. If compliance is involved, is heavy in compliance. Or am I going to something that is specialized and then my customers choose? So different ways of going about this.
Going back to the compliance thing a little bit, and you talk about the game of this whole side of things. I feel like AI is going to change it a little bit, right? Compliance is going to go, it's going to keep growing. Like you said, it's still growing, it's still increasing. But how are you going to manage AI, or how are you managing AI? How are you introducing it, implementing it?
Yeah.
And how does that alter the finance game?
Yeah. Well, I think on the compliance side, once you have many hundreds of clients and automation of processes is going to make a lot of sense. I think AI can play a role in reducing overhead costs, and a lot of companies that are in finance and investing that have large customer base are going that way. So I think one is efficiency. The other one is the way I'm using AI mostly is in my business. I try to, maybe I should say, like in investing, if you want to be above average in your investment success, you have to have two things. One, your investment thesis has to be correct, right? Because if you're not correct, you're losing money. And second, your investment thesis has to be different than that of the general population of investors, right? Because if you're right, but you're doing the same things that others are doing, you're going to get the average performance, right? You only get above average when you're right and different. So to do that, I've decided for RICHTWERT that I need to make these decisions independently. So I don't read research from other analysts and so forth. I look at the business, I decide whether I can understand the business or not. And with that, I mean, can I look out 5 to 10 years? If it's an industry that is changing a lot, I don't think I have a chance to know what that business is going to look like 5 or 10 years down the road. Because so many things are going to change. So it's got to be, I have to be able to reduce it to a few parameters. And these have to be constant over time. That's one. The second is I look at, okay, does this business have a moat, an advantage that is enduring, right? And why is it going to be enduring? Because capitalism is very brutal, right? As soon as somebody starts making a lot of money, it attracts a lot of copycats, a lot of competition. So you have to be able to protect that fortress, right? And I have to be able to recognize what is that competitive advantage. If I can't realize it, then I don't think we have a reason to invest in that business. And the third thing is the management, does it stand out, right? And there's a lot of management that is probably good, maybe good. It's hard to judge, right? There are some people who are crooks and some people who are clearly above average, right? So I try to find only those where I'm like, okay, this is not the norm in terms of management, right? They really have skin in the game. They have proven track record of doing things. And the last thing that I want, like when these three criteria are met, is I want to make sure, even if the world changes or if I did mistakes, that we don't lose. Or if we lose, we only lose a little. So in the analogy of climbing a mountain, I want to have a lot of safety nets that protect us because the future is uncertain. No matter how much analysis you do, how intelligent you are, how big your team is, you don't know what the future holds. So the best way to do that is to have things where increase the predictability of it, as I mentioned with the three criteria before, but then you need to have a wide margin of safety. So for that, I do look at these businesses, I narrow it down to the ones that I can evaluate and value, and then I value them independently without looking at any research. And then I look at the stock market. So if I evaluate the business and I think, this business is worth 100 to 140 million, and it's got that many shares, so that means, its stocks are worth 10 to 14. And then I look at the stock market, and if we can get it for 5, because that's what the market prices the stock at, then I think, we have a pretty good margin of safety, right? Because even if it's not 14 or not 10, because I did some mistakes, there's a lot of room until 5. So we have a lot of protection there, right? But if I value that 10 to 14 and the stock is at 12, then I think, this is too risky because we don't have that margin of safety that protects us. And this is where AI comes in. So for all these criteria, I make my own analysis, but then I also use AI for 2 things. One is as a sparring partner to see, did I do anything wrong in analyzing that criteria? Like the predictability of the business over 5 to 10 years. What about the management? What about the competitive advantage, right? How would you value this business, right? So I'm using it as a sparring partner to see if I have any blind spots or if I did some mistakes or are there things that I should be considering that I'm not considering. That's one. And the other way I use AI is once I've talked to AI and kind of told it what kind of businesses I'm looking for, what my criteria is, I say, okay, now go and apply, right? I'm interested in that industry. Can you find businesses with these characteristics and tell me why you think they match my criteria, right? So it's a idea generation, but a directed one to see, can I come up with additional ideas?
And I guess we're just taking the scope out a bit from compliance and regulation, and it is probably on the minds of everyone, listening in through the camera and the audience, considering, you're the founder of an asset management company, to however much detail or, however descriptive and stuff you want to be, that's to your choosing. But where should people be looking? If you had to give, a top 5 markets, verticals, or even specific businesses to be looking towards as an investor going into the future, where should people, ordinary people maybe like us on just a average wage, where should they be looking?
I think you should start looking where you have a lot of understanding, right? I mean, the rule number 1 is only invest in things you understand. Because when you invest in things you don't understand and the market goes against you, what do? Do you double down?
Yeah.
Or do you go out before it goes further down? You have no anchor, right? You have to be able to value the business, and that gives you an anchor, right? I like the things that we invest in. I always tell my partners, and it's a little bit counterintuitive. I tell them I don't want these stocks to go up, although we invested in them, because most of my clients, every one of them, they're net savers, right? They're making more money now than they're spending. And sometime in the future, 10, 15, 20 years, it's going to turn around, right? They're not going to make that much more money because they retire or don't want to work anymore. Now they need the money, right? But until then, it's actually advantageous if things go down. Because if you're buying, do you want things to go up or go down? If you're a net buyer, you want things to go down, right? It's like, you like wine or hamburgers. Do you want the prices to double? No, you want it to go down. And so I say, we bought this business and I'm happy to make it a bigger investment for us if it goes down because I think I know what it's worth, right? But that's very important. That is your anchor. You have to know, actually the word RICHTWERT means to have an anchor value, a value that you're going with. This is a German word. So if you don't have that, it's very hard to do investing. You can speculate, but that's like going to the casino. So that's why I say start where you actually know things, right? So if you're a tennis player, look there, right? If you're collecting things, look in that business where you're collecting things. If you're in an IT business or consulting business, look in those areas. Because there you might have an unfair advantage versus others who are not that in that industry or in that special. And the same thing goes for geographies, right? If you grew up in Australia, you can go there and say, you can visit the businesses, you understand the culture, you understand the management better, and you already have advantages that you can start with. The world is a very big place. Find your niches where you already have competence, right? The circle of competence is very, very important. Because at the end of the day, when you're buying something or selling something, there's somebody on the other side, right? And the way to win is to know more about what you're buying or selling versus the other person on the other side. And where are you going to have it? Are you going to have it in biotechnology if you don't have any background in biotechnology? Probably somebody is smarter, right? So try to compete in areas where you have an edge.
We've obviously covered quite a few more complex topics for people who might already know a bit about investing, but for our younger audience, for people our age, just coming out of high school, even in high school, just some general questions that I've got. Well, first of all, if you had to explain simply, what is investing?
Investing is consuming less than you're making or you have to put it into something where you have certainty that over time it's going to give you back more than you put in. That's investing, right? And the way to do that is, as we discussed, is to find things where you know things, and it's usually things that you're consuming or things that you're exposed to, because if you're in school, it's maybe a business that your parents are doing, right? Or other things. So that's investing. If you want to be selective, I mean, there are two types of investing, right? You can be an enterprising investor. That means you make active decisions, right? You select businesses that you understand. And I would go with things that you understand because of your circle of competence and things you admire, right? If you go with a great business that you admire and you have very good reasons why you admire it, over time, that business is usually going to do very well. That's one. But if you don't want to be an enterprising investor because your passion is somewhere else, let's say you want to be a rocket scientist, or you're in biotechnology, or you want to be an influencer, or whatever it is, that's totally fine. You can completely be a very successful investor without knowing anything, right? It's just important to make that decision. Are you a know something investor or a know nothing investor? It sounds a little bit black and white, but it helps to keep it black and white like that. Because when you don't know anything, you can just invest in the entire market, right? And if you do that over time, you're going to have an amazing result, right? So that also works fine. But you should start early, and you should, like, let's say you're a know-nothing investor, or you decide, hey, I'm not going to be an enterprising investor because I want to open a restaurant, or I want to be a professional tennis player. Then you can say, especially when you're young, start as early as possible. Just put 20-30% of whatever money you're getting, either from working or from your parents or whatever. Just put that aside and say, this is investing money that I want that to compound over time. And then every month or every quarter, take a constant amount. It can be 100 Australian dollars, US dollars, or it can be 1,000, whatever it is. But keep that amount constant and say, okay, every quarter, I'm going to invest the same amount, and then diversify it broadly by, taking the MSCI World ETF that just gives you exposure to the entire world, right? And just keep doing that. By doing that, let's say you invest $300 every month or every quarter, right? Now, when you're in a phase where everybody is very optimistic about the market, right? The prices are high. Your $300 are going to buy fewer pieces of stocks, right? Because the price is high, right? Let's say your price is at 100, you have 300, so you get 3, right? And there are times where people are pessimistic. Instead of 100, it's now 50. right? Your 300 buy now how many? 6, right? So automatically, when everybody is optimistic, you buy less because prices are high. And when everybody is afraid, you buy much more, right? So you don't just get an average price that is attractive, you get a way better than average price. And if you do that constantly, but you should do that really, you say, okay, I'm going to do this for 10, 15, 20, 30 years, right? You'll be surprised after 20 years, even with very small amounts, how that adds up and becomes enormous. That's the power of compounding. For compounding, you have to make sure you have an attractive rate at which it's compounding. And it doesn't have to be phenomenal. It doesn't need to be 20% a year. 6, 7% a year, which markets do in general, is more than enough to make a fortune, right? But you need to start early and let time build this magic.
Time in the market.
Time in the market, right? Don't try to time markets. Don't try to pick things unless you want to be an enterprising investor. That's a different game, right? It's like when you want to become a professional tennis player, right? How much of your time do you have to spend playing tennis, right? Well, that's the distinction you need to make. Just to be, a good tennis player is better than to be a know-nothing investor, because then you're a danger to yourself. But if you're going all the way, you want to be enterprising, go for it, right? Pick things that you understand, try to invest there. If not, and that's 90% of the people at least, right? Just let time and compounding do its trick. You keep costs as low as possible, diversification as high as possible. It's never been as easy as it is today to be diversified, because you can take an ETF that just mimics the entire world. You get it for less than 0.1%. So fees are very low, and you just put it on autopilot. You ignore all the experts. I don't care who they are, how successful they are. You ignore me, everybody else, right? Because people are emotional. When things are very cheap, they're cheap for a reason, right? People all run away. That's the best time to invest. And because you're also going to be emotional, just keep it on autopilot, have the same amount, and just do it over time.
Yeah, and I think it is crazy. And I think for anyone who's at home who hasn't already probably done so, if you could just pull up one of those calculators that can show you that compound growth, even just 6 to 8% per year annually, with even such a small amount of money, to see how that can grow in 10, 20, 30 years time. It is truly remarkable, and I think it will blow anyone away. But for you, what do you feel is a widely accepted investment belief that you disagree with?
Oh, there are many. One we already talked about is wanting your stocks to go up. You should actually, especially when you're young, when you know what you own, right? And that can be a specific business that you have invested in, or the entire world, right? You still know what you own. Like, I own the world economy, right? A very small piece of the world economy. And yeah, can the world economy also go to hell sometimes? Yeah, it can happen. But I think then we have other problems than our stocks going up, right? So once you know what you own and you're going to be investing, so you want it to go down, you don't want it to go up, so that you can buy more and more of what you like, right? So that's one belief that is wrong. The other one is that you have to be right about the macro, right? You have to know where the macro economy is going when the next recession comes. The timing, nobody gets it right. And if they get it right, they get it right once and then 3 times wrong, right? Timing is one of the most dangerous things you can do in investing. Just be in the market. Don't invest it all at once. If you have 50,000 to invest, say, okay, I'm going to invest this 50,000 over the next 3 years, and then it's going to remain in the market, right? Try to dollar cost average, as I mentioned, and don't listen to anybody. Just do autopilot, right? You should actually write a contract with yourself. In there, you should say, I know there's going to be times where I'm going to be scared, or times where I think, oh, I found, something really exciting, and then I'm going to pull out this contract where I promise not to do it. I'm just going to stick to my autopilot. So these are some of the things that are maybe counterintuitive, but very, very helpful in investing.
I think that's amazing advice because,
absolutely.
especially around our age, it's not that big of a thing, especially back in Australia as well. It's investing young people, it doesn't really mix together, you know, there's not that much awareness about it.
Yes.
And I think having that awareness and knowing the potential, you know, the potential upside to it in the long term could be really beneficial for a lot of people growing up our age and stuff like that. But you know, what about non-traditional assets now? You know, going into even things like crypto.
Well, as far as investing is concerned, I think you have to come back to things that you can understand and value, right? I'm a firm believer if you can't understand something, you can't value it. That's one. And the other thing is, if you invest in an asset, now it can be a business, it can be real estate, like an apartment or a house, it can be a farm, it can be a franchise. Those things are productive assets. By productive, I mean the assets generate a return, right? Like real estate, you can either live in it and then you don't have to pay rent, so you save money, right? Or you can rent it out and collect the rent. In a farm, it produces, I don't know, apples or kiwis or something. You can sell those, you get a return, right? A business hopefully generates a profit and distributes that at some point. It generates something. Now, when something is productive and generates something, you can take the return in apples, kiwis, rent, or profits, and say, you know, how much is that profit worth to me when it comes today, or in 3 years, or in 5 years, right? So that cash flow that accumulates to you over time, you can say, okay, how much is it worth? Obviously, the further out it is, the less it is worth, right? The sooner it comes, the worse it's worth, but it's not worth less, right? So you can try to estimate those things and say, you know, how much is it worth today? So you can value the asset, right? Just like when you buy a real estate, an apartment or something like that, you don't know how much rent am I going to collect, how much is it going to cost me? And over time, over the next 20 years, you know, rent is going to go up by this much, I think. And how much is all that cash flow worth today? That is investing, because you're evaluating things, you're valuing things, and then hopefully you're trying to buy it for less than you're going to get over time, right? When you invest in something that doesn't produce anything, and that's not only crypto, that's gold, that's art, those are collectibles like cars and stuff like that, there is no income that is produced. It doesn't generate anything. Like you can look at gold, you can look at your crypto, maybe it's hard to look at crypto, but but there's nothing that comes out of it, right? So it is impossible to value it because there's no cash flow that you can take and say how much is that cash flow worth, right? The only thing you can do with an asset, and I would argue that it's actually not an asset if it's not producing anything, but people call them assets. Let's, for that sake, say it's an asset. If it's not producing anything and you can't value it that way, the only thing that remains is somebody else going to pay me a higher price, right? Whereas if you invest in your own business or in a restaurant chain, or you decide, you know, I don't know, TikTok is a great business because everybody needs to generate demand and influencers are there and so forth. What is TikTok's cash flow production going to be over from, right? You can value that. And even if nobody pays you a price, there's cash coming in from that business. Like, okay, you know, I paid 100,000 and every year I'm collecting 15,000, right? Even if you can't sell it because nobody's giving you a good price for it, you have a return. And you're like, okay, but the returns justify the investment that I made. When you invest in gold or in crypto, it's just, is somebody going to buy it for more or not, right? And if you bought it for 100,000 and it's at 50,000, you can't just say, I'm going to ignore what other people are saying because you're not collecting anything in terms of income, right? If I invest in Meta as a business and I don't like the stock price where it's trading, I don't have to sell because I'm like, oh, but it's producing profits for me that I like. It's like when you own an apartment, right? You buy an apartment for $500,000 or $1 million, you're collecting rent. If somebody comes and gives you 15 million for that same apartment, I'm gonna sell, right? But if somebody comes and says, I don't care what you paid for it, you paid $1 million, I'm gonna buy it for 700,000, right? You can say, I'm not gonna sell it for 700,000 because the rent is pretty attractive, right? But if it wasn't producing that, then you're at the mercy of what others are thinking, right? And that's not investing, that's speculating. There's nothing wrong with speculating, right? There's smart speculating, there's less smart speculating, but it's speculating because you don't have any income that lets you be ignorant of what other people are saying, right? You can say, I don't care what other people are saying because I like what the asset is producing. So I think it's very important when you're investing to know when you're investing, when you're speculating. Because once you know the difference, then the stakes are also going to be different, right? You can speculate, but because you're speculating, you're maybe only going to do it with 10% of your money, whereas 50% is going towards investing, for example. Right?
No, it's really interesting actually how you've translated, I guess, your psychology, maybe your business's psychology of value throughout this conversation. And it's really intriguing to hear how you translate that. But just shifting lens a bit, what are Bahram's interests and hobbies outside of business? What do you get up to? What do you spend your time doing?
Well, I find technology very fascinating. So I read a lot about technology and things. I find history very interesting because I think out of history you can gain a lot of perspective for what may happen in the future. And also, you can also appreciate things like when you see how things went wrong and you see things becoming worrisome, like, okay, then and then people didn't, react that way and see what happened. So I think history is a very good teacher. Other than that, I just living in Switzerland most of the time. I enjoy hiking and nature and being together with friends and family. These are the things. The quality of life to me is more important than the quantity of life, because we all have limited time on this planet, and if we can enjoy it. And one advice, I know your audience is young people trying to decide what to do. It's something that I realized a little bit late in my life. I wish I realized it earlier, but I would say, pick something that you're going to enjoy regardless of the outcome. Because that way, if you go through that journey and the outcome is great, you have a double benefit. You've enjoyed the journey a lot, right? And the outcome was great. But if the outcome doesn't, right now there's a lot of uncertainty. What is the AI going to do? What's the future going to look like? Are we going to have any jobs or not? Things like that. And even if the outcome doesn't turn to be amazing for you, if you picked something that you really enjoyed, where you're like, okay, I think I'm good at this, and I actually have passion about it, and I think people are also going to need it, that's going to be a very satisfactory journey for you, regardless of what happens at the end, right? We always tend to focus on the end, and then we make a lot of sacrifices on the way to get there, but sometimes the sacrifices we make to get there are not worth it, right? So it's very important if you can combine it, or like, hey, the outcome is probably going to be great or good, right? But the journey to get there is also very good. I think that's going to be very fulfilling life.
That was a really good response, and I think just even within my own understanding and processing, I really took a lot out of that. And for you to share those stories that maybe on one side of you wish you had learned a bit earlier, but how now you've changed that shift of value and how you segment your time and stuff is really interesting.
One final question is, what excites you most about the next 5-10 years, and where do you see the most opportunity in the finance industry, in the investing industry?
Well, I think what is happening in technology is really, really fascinating. It's a little scary too, but I think with what we're finding out, things and the tools that we are creating with AI, and I think it's going to lead to scientific discoveries that we have been struggling with. And also it's going to help us maybe ask questions that we didn't know we needed to ask. So I think it's the exponential nature of how the world and life is evolving is very fascinating. I hope that we find a lot of cures for a lot of diseases that cause a lot of suffering. Um, the other thing that I hope and I'm optimistic on is a lot of people have this limited view of, for if they think if they want to get ahead, somebody else has to lose. So it's like a what do you call it, a constant sum game. I don't think that is true at all, right? The most attractive businesses or the best businesses are the ones that create new markets. They don't just take market share, they create markets and then they make it bigger, the pie bigger for everyone. And I hope with technology and things that are evolving, more and more people will recognize that, somebody else does not have to lose for you to win. There are things that are just additive, they create just value, and we go more about world that way. I think that's going to decrease the amount of conflict that we have in the world. So I'm hoping for a more peaceful, more fruitful, and also a world where people can take up their passions more. Because a lot of jobs, people are like, I need to do it. I don't really love it, or I don't like it at all, but I have to do it to feed my family or to have a future. And I hope with things that are coming, with the abundance that I think AI and technology is going to create, people have more choice and freedom to say, I want to become a teacher, or I want to really be good at music or whatever it is, to pursue their passions a little bit more, knowing that, the basic needs are going to be more than covered. I think that is going to create a more inclusive and more richer society where we appreciate the more nuanced skill sets of each and every individual rather than forcing them into something just because there's money in it.
Well, thank you so much, Bahram. We've covered a lot of ground there, from your authentic individual upbringing to, your early professional years through, Germany, the USA, Switzerland, and obviously now here in Dubai. Those entrepreneurial journeys and the lessons and insights you've been able to communicate to us that you've probably learned the hard way at certain times along the way, to then, more personal life stuff and then a future outlook. I feel, the question leaving to the conversation is for people to shift their time period scale that they look at when making investments, from that short term 3 to 6 months, that dopamine hit, that instant dopamine hit, to more 5, 10, 15 year accliments. But thank you so much for coming on.
Yeah, and it's not only financial investment, it's also even more so the investment that they make in themselves. If you start looking at the investment you make in yourself over a 10-year time period, I mean, there's almost nothing you cannot achieve if you give yourself the time to build up to it in 10 years. And it's very hard to do it in 3 months, right? But if you give yourself that and you say, I'm going to do it and I'm just going to keep at it and get better every day, a little bit better, it's amazing what you can achieve. And yeah, I hope. And also don't be afraid of failures. I mean, especially when you're young. Every failure gives you so much for your life. And sometimes, I mean, of course, it helps if you learn from other people's mistakes. But when you're young, mistakes don't really hurt, right? You don't have much to lose. You should try as much as possible. Fail early, learn from it, pick yourself up, try something new. The world is a big place.
Absolutely. It's your optimism, I think, that throughout this conversation has shined through for me, because, your positive thinking in all the steps, your business, your life, looking at the positive sides, how to actually do better instead of, just falling to the negative side. So no, I've taken that out of this conversation. So thank you very much.
Thank you very much for your very interesting questions.